How many times, Joey, have you had someone either comment on one of our posts or even make a comment to one of our coaches and say, why would I ever want to borrow my own money and pay interest for
You mean like today?
it? Yeah, exactly.
Constantly. This has got to be one of the biggest hangups about the concept of infinite banking. And today we have to just nail this down.
Well, where's the biggest flaw, though, in that comment?
Well, first of all, you're not borrowing your money.
Whose money are you borrowing?
You're borrowing the insurance company's money, and your money's just collateral against that.
The insurance company then is going to charge you interest, Joey.
Yeah, just like anybody else would.
Well, I had a guy the other day, we have this video that really has rubbed some people wrong. The video is why Dave Ramsey's wrong, and we've got the math to prove it.
About life insurance.
Right.
Yeah.
And it is, we've got several hundred comments on this video. People get so fired up, but that is one of the common things. They'll say, well, why don't you just get a HELOC? Why do I want to borrow my own money and pay interest on it? I'm like, well, wait a second. You just were talking about a home equity line of credit. You're borrowing money from a bank. And if you do the exact same thing with an insurance policy, you're just borrowing money from the insurance policy. What's the problem here? Well, the interest rate at the bank's lower.
Maybe today, maybe for 1 minute.
How about the fact that did we not just a couple roundtables ago share how you actually can lower your interest rate?
Yeah, absolutely.
There's so many things about paying interest on policy loans that is sometimes misunderstood or unknown. And that's what this episode's about, how to get clarity into all those answers. Let's belly up.
Welcome to the Wealth Without Wall Street podcast, your guide to understanding how to get out of the Wall Street rat race and start your own mailbox money lifestyle. Now, don't let these handsome Southern draws fool you. These financial minds are teaching our country to enhance savings, increase cash flow, and create passive income, all without the help of Wall Street. Are you ready to break through? Now here are your hosts, Russ Morgan and Joey Murray.
Welcome into another day of the IBC Roundtable, where we peel back the onion on the infinite banking concept and all the little details that goes with that. I'm your host today. I'm Russ Morgan. I'm sitting here with my favorite buddy, the Italian stallion, Mr. Joey Murray. What's up, Joey?
Howdy, howdy. Glad to be here.
Well, are you really here? I mean, we're here, but you're not. Where are you today?
I am in the closet, bro. Had to come home and hang with the little ones while mom had to run some errands. So we're making it work.
All right. Well,
he's in hiding.
He's back in hiding. The Italian stallion has done something again. He is on the move. We've also have our resident pilot, the man who gets you to your financial destination safely, Mark, the Gooch Haraguchi. What's up, Mark?
Not much, guys. Just stoked to be here again for another one.
That's right. And by the way, just if you're not able to see us, you're missing out, because there's moments when we're doing this live presentation where people who are a part of our inner circle get to participate in some of the fun. Like right now, I'm trying to find. Can you guys see Mark? Can you see him?
He's pretty much camouflaged at the moment.
He's blending in.
Is Mark here?
And it's you're missing out. Be a part of the inner circle. Go to wealthwithoutwallstreet.com/inner circle so you can participate in some of the fun that we're having. But around the table, a coach of coaches, the man with the $1 million smile, Mr. JD Hill. What's up, JD?
Hey, $1 million smile. You've elevated me now. Thank you.
Well, I mean,
I like it.
The fact that my wife is a dentist, that's one of the, she points out smiles to me constantly. And I just know that she would be proud of those pearly whites you have.
Well, I'm flattered. Thank you. That's, I've moved up from having no nickname to I now have a nickname. So thank you.
Just give it another week. We'll come up with something else.
Yeah, I was going for
perfect.
Aaron Rodgers' little brother, Hill.
Yeah. Not the
Okay.
same.
Mm.
And the man,
Not the
last
same.
but not least, the man of consistency, downtown, Ernie Brown.
Man, what's up, Russ?
How are you, man?
I'm doing great.
You guys ready to talk about interest on life insurance policies? What could be more exciting than life insurance and policy loans and paying interest on them?
I mean, maybe watching paint dry, but that's not what we're covering today.
Well, this is a topic that when we're trying to break down the infinite banking concept as a whole, one of the main premises here is that we're taking loans against life insurance policies, right? Not any life insurance policy, but dividend paying life insurance policies. I was going to say that as if that was going to make it more exciting, but after I said it, it was like, that's not really that exciting, is it, Ernie?
What about dividend paying whole life insurance policies? Is that better?
Ooh, the whole part.
Mhm.
That gives it a new little flair. Well, this is a part, though, that is integral in step 2 of our process. So if you've never gone through our process, step 1 is getting clarity, knowing where you want to go and where you are currently. And when you get clarity, you know where you're going, and you know why you're going to get there, and you know what obstacles stand in your way. You're going to start working through the control phase, which is step 2. And that's where the whole infinite banking concept comes in. We're saving money in life insurance policies, but we're not just leaving it there, Ernie. Our goal is to do what with the money?
We want to borrow against the cash value, specifically to either create streams of passive income or to take over our monthly debt payments.
Now, is there anything, Mark, that you can think of, any business out there that uses someone else's money and goes and puts it to work for the purpose of profit?
Let me think. Oh, yeah. I would have to say it starts with a B and ends with an ank.
That is a 4-letter word, right?
Yeah,
there.
it's what you do when you're flying, right? You have to bank your airplane.
Yeah. Nice, Russ. Good segue.
Nelson would love
I have
that.
to throw that in as many times as I can, but that's what we're talking about. We're talking about borrowing money from an insurance company, and we do that. It's going to create an interest expense. So, JD, really high level, share with people, if I borrow money from an insurance company, just what high level, how does that even work?
Well, it's different than how it works with a bank, where I have to fill out, an application to get approved and a credit check and all those types of things. I candidly just submit a piece of paper to the insurance company that says, I want access to my funds, or rather to your funds, and I want to use my money, my policy as collateral. And they basically say, well, do you want us to mail you a check, or do you want us to EFT the money into your account?
So can I borrow an infinite amount of money against my insurance policy, Joey?
No, that is not why we call it infinite banking. We call it infinite for other reasons, but you are limited to the cash value amount that you have accrued in your policy.
Well, so how does one then they get to the point where they've built up cash value? Is there like some waiting period, Ernie, that someone has to wait? Is it like 5 years? Is it till 59 and a half, like most of the stuff that they're used to putting money in that they can't get money out of? How long before they can access this policy loan we speak of?
Well, I think that is something that when I talk to people are nervous about. They think that they've heard some things like months or potentially years, like you're saying, but no, the reality is a lot of our folks go get policy loans within the first month of starting a policy. But even the reality behind that is once you make a premium payment to the insurance company and they credit you with cash value, you can borrow against that in the matter of just a couple of days.
Gotcha. All right. Well, let's talk about some details that people love to ask us about flexibility. They like to talk to us about rate. Joey, you're in the mortgage business forever. And that was probably one of the first questions you got asked is, what's the rate, right? So let's talk about what's the rate on taking a loan in today's environment from an insurance company?
It can vary somewhat, but typically it's 5%.
And is that the end of the road? So how is that calculated?
So I think this is important, because some people, when you think about interest and you think about how much something costs, you think about it in terms of payment and only specifically on rate. But at the end of the day, the terms matter. And so when you think about taking a loan against a policy, the terms in which you can do that with an insurance company is 5% interest only payments. Okay, so just to give you a very specific example, if I had $10,000 in my policy that I wanted to borrow against, I borrow that loan on January 1st, and I don't pay a dollar back all year long, which, by the way, is another term of borrowing the loan. I don't have to pay back every single month or every single year any amount. There's no structured repayments, but I do owe interest at the end of the year. And so if I borrowed it January 1st, $10,000 at 5% would be $500 at the end of the year that I owe in terms of interest for the use of that money. And that's all that at the end of the year, I get a statement that says, hey, by the way, you have $10,000 loan outstanding, $500 interest has accrued. You can pay that now, or we can add it into your loan balance for next year.
So if you don't pay it, then it would be compounding interest. But if you do pay it, it's just simple interest, correct?
That's right. And the other part that I want to add to that is compared to what, right? So if I took a $10,000 loan from somewhere else, let's say it was a bank loan, and they said, well, you know what, the interest rate is 2%, right? But they said it's a 12-month loan. Well, does the interest rate matter at that point? If I have to make payments back over the course of the next year at 2%, think about that. Like, what would my payment have to be to repay that $10,000 loan at 2% over the course of this year every single month? I'm guessing, maybe one of you guys knows off the top of your head, at 2%, it's probably somewhere around what, $900 a month that I'd have to pay back in order to pay that back within 1 year.
Right.
Okay.
Yeah, that's
compare that to the zero payment I have to make all year long, and I owe $500 of interest at the end of the year. That is a game changer, depending on what you're investing in, whether that be real estate or something else. The fact that I don't have a payment to pay back, that's a game changer.
Well, I think it is. It comes down to flexibility, right? I mean, the rate of return or the rate in which we pay on interest is all relative compared to what. And, you know, most of you listening to this are on your path, on your journey to financial freedom. And we know that formula is when we have more passive income than we have monthly expenses. And payments of any sort become a monthly expense. And there's times where people will take a policy loan and go pay off a debt that they have that frees up cash flow, right? And immediately they have now, in essence, refinanced their debt at the insurance company. Now, it doesn't mean it's free and clear, right? If we don't pay back that debt to the insurance company, effectively, what have we done, Ernie?
If we don't pay back the loan,
yeah, we
have just reduced our death benefit.
We've reduced our death benefit because that's what a policy loan is. It's a prepayment of the death benefit. Now, this is a question my wife asked me probably for the first 3 years that we were doing infinite banking. She kept going, but why do we pay it back? I don't want to pay it back. It's just, isn't it just my money? Why should I pay it back? What would you have told my wife?
Well, I would
easy,
tell you,
by the way, easy.
Aside from that, I would tell her what I was meeting with a guy this morning, and I would tell her what me and this guy were talking about. We were going over his cash flows, and we calculated between credit cards, some personal loans, some student loans, some car payments. Outside of the mortgage, he has got $1,800 in monthly debt service payments.
Okay.
$1,800 a month. And we're building a policy where the goal is financial freedom, but his first stop is he needs to take over those loans. So we're going to slowly, one by one, take those over. And to answer your question now, Russ, what would you tell what would I tell your wife is that as he pays off that balance at a credit card company and he's paying $150 a month to them, he's going to continue paying $150. But instead of paying it to the credit card company, he's going to pay back the insurance company, because every $150 he pays back, he has access to again.
And that's a point I think is so important, is when we pay back loans to our cars, our houses, the furniture, whatever it is that we've borrowed money for, when we make those principal and interest payments, it's not like there's now this available cash. If we want to go back to the furniture company, I'm going to take me back to like when my wife and I first got married. I was an amazing husband, right? I mean, she married up. I mean, she got a coffee table, 2 TVs, and 2 folding chairs. That's what came with the marriage. That is amazing. Now, that was not enough for her. She thought the folding chairs were not what she would want to have friends come over and sit in, considering it was only 2. So I wasn't going to sit on the ground. So either her or a friend was going to have to sit on the ground or the coffee table. So she decided to take us down, and we went to the furniture store. And of course, we go and pick out all of this stuff, and it's a couple $1,000s, and I'm right out of college. I don't have the cash. And they say, you know what? You can get it 0% interest for 36 months or whatever. Now, all they did was sell me a $5,000 or $500 couch for $3,500, right? And then they spread it out to make it seem like 0% interest. But the point is that I had this payment, and I was making that payment every month for 36 months. But at what point in time, JD, could I have went to the Havertys or whatever the place was I borrowed the money from after making $500 worth of payments and say, hey, you know what? I need some of that $500 back.
At no point in time. I mean, you could do it whenever you wanted. Right?
You could ask too.
I could have asked.
You can always ask, right? But they're not going to honor that request.
Right. And that's one of the things that we've known in our life if we have loans and we make payments on them. One, we feel the heaviness of that payment, but we also know when we make that payment, that money's gone. And that's why a lot of times people, Joey, think about in your mortgage days when people were wanting to pay off houses fast, right? That was an idea. But every time they get ready to make the big lump sum payment on something, what was probably one of the biggest questions they were asking themselves?
Oh, they were always hesitating because what if I need this money back? How am I going to get my hands on it? I either have to go back to the bank and ask them for the permission under what terms I refinance, pay them fees, and what terms can I get it back on, or I have to sell the house in order to get that money back. So it's essentially locked up.
So when we make policy loan repayments, Ernie just said that we actually, if we needed the money back, we would just go through that same process that JD explained on the front end, is that we fill out a piece of paper, we send it to them and say, put the money in this account. It's that hard. All right, so this is where I'm going to stop, because Ernie, we had some questions that came in from our community, and I want you to lead this, and you can throw them out. I'll let Mark be the first one to answer the first question, but you divvy out the questions here, because I want to make sure this is the most important thing, is not us talking about this subject matter, but us answering the questions that are really on your mind in any of this. So you can always, inside of our community, you can put these questions, and our goal is to answer these on these podcasts and in these chats, because it's the most important thing for you to know, how does this work for you? So Ernie, throw out a question to Mark.
Yeah, perfect. Here's the first one. And a couple of people asked this question. Really, they just want to know, how do I get started? So I'm going to interpret that question and say, how do I know when I need to make a policy loan?
Ooh, it depends. I mean, it really does. And at least from my perspective, what are we trying to accomplish? What is our goal? Do we have a credit card debt like we just talked about? Do we have something that we can target? Have we used Joey's paying down debt like a boss priority payoff guide, right? Let's get in there. Let's take a look at what's happening in your finances. Do we have a high risk target? In this example, let's just go with the answer of yes. Okay, that might be a really great opportunity to go and initiate a loan from the life insurance company against your cash value. And I'd just like to add in here, I've asked this of pretty much everyone that I work with is, and I'll throw this to, actually, Russ, I'll do you a favor. I'll throw you back one. What are the 2 questions you can expect from the life insurance company when you call them and ask for a loan?
How much do you want, and where do you want us to send it?
That's it, folks. None of your W-2s, bank statements. I want to know what are you getting? What are you using this for? How do you plan on paying it back? None of that stuff. It's very, very simple.
Game changer. Yeah.
So another way to say that would be how do I get started? How do I know? Is when you want to have control.
Right.
Those are very simple. If you're willing to answer those 2 questions, it might be a good point. Behind that would be, how do I know how this loan interest works? One of the best questions I think we got was, I'll just read it. I'm currently paying a loan back and would like to pay it back with market rate interest. JD, maybe break that down for somebody who doesn't understand why in the world would somebody pay back at market rate interest? That's a great portion to the question. So interpret that. And then here's the second part. Can I do this without hitting a MEC or over investment limit? So I'll interpret that as well, is when we pay back loan interest, where does it go?
Wow. You didn't give me the softball like you did for Mark.
Thank you.
I think if you go back to Nelson's book, right, Don't Steal the Peas. And if you're going to be an honest banker, right, you'd want to pay yourself back at market rate. The same way you would if you were going to borrow money from, the banks in general. And, you want to make sure you're running a profitable business. And so paying yourself back at a market rate means that you're being an honest banker. So that to me would be the answer to the first part of the question. The second part of the question is, where does the excess go, or where does the loan interest go? What was the second part of the question again?
Yeah, both of those for sure.
Okay. So the loan interest goes back to the insurance company for giving you access to their funds, right? It's just the cost of doing business. Because the reality is that the insurance company is going to loan that money out either way. They're going to loan it out to you as a policyholder, or they're going to loan it out to somebody else who wants to borrow funds. And so that loan interest goes back to them to operate their business. The excess dollars, though, would go to essentially one of 2 places, depending on how you opt to do it. Would either go to pay down the loan faster, right? So going towards more principal to pay the loan down faster, or if you wanted to apply it as additional PUAs into the policy to increase, obviously your PUA contributions into the policy as well. So you get to direct what you want that payment to do, which I think is so unique to insurance loans, is I can pick to do principal, I can pick to do interest only, I can pick to do a combination, I can pick to have funds going towards PUAs. I mean, you are in complete control of that whole transaction.
Well, and you said something I want to break. This could be missed. Market rates. Joey, what is a market rate of a credit card right now?
I don't know, maybe 15%, 18%, depends on the carrier.
Okay. So does that mean then if you paid off a credit card with your insurance policy as collateral, so you took a loan from the insurance company at 5%, should you be paying back 15 or 18%?
Yeah, absolutely. I would pay back the same amount that I was willing to pay that credit card company by all means.
Well, why wouldn't we, right? I mean, I made the comment earlier about JD's teeth. It reminded me of when I was my wife was a dentist. She had a dental practice. I had read the chapter in the book where he said, if you owned a grocery store and your wife came in to shop, what price should you charge her for the can of peas? Should you charge her wholesale, retail, or captive customer retail? Because he said if the can of peas, if they cost 57 cents and you sold them at retail at 60 cents, you're making a profit. But here's the thing, is that your wife is a captive customer. So is all of your friends and all of your family. Where else are they going to shop? So why in the world would you give them any deal? You ought to mark up the price. And so when I saw that, it reminded me every time I went to my wife's dental office, I needed to pay at least what everyone else was going to pay. And that's a really hard pill for people to swallow. And the purpose of this is Nelson saying, whose money is more important? Do you value your money or the bank's money more?
Right. It should always be ours.
It should be ours. So that's it. That's the reason why you should at least pay back market rates. You really should pay more than that, because if you value your money more when you use it, and all he's doing, he's helping change human behavior. And if you notice, if you ever read Becoming Your Own Banker, he goes through the 5 human factors, and he's always trying to touch on the point that we have this human behavior that's naturally going to want to spend our money and not repay it. And if we can change that habit, we win by default. Right,
That's right.
Ernie?
That's
Yeah.
right.
What other questions we got from the
Yeah.
community?
Before moving on from that, one other piece to that question that I think, just knowing who this came from and maybe knowing a little bit about it, the point of paying back the policy loan, and JD said this, is if you charge yourself a market rate, the cash is going to go back into the policy faster. So we talked about having access to it again, but the policy loan can only be paid back to 0. And so then what do? Well, we can either see if the policy can fit in more premium, or we need to take those dollars and make another policy. The fear isn't that paying back a policy loan is going to create a mech,
Right.
or that's coming back into the policy at too fast of a rate. Actually, the insurance company doesn't care at all what rate the money comes back. In fact, they aren't really concerned if it comes back at all. So it's a different side. It's not premium. It's
They're
loan
not
repayment.
keeping up with each individual loan as we get when we get loans from the bank. They're keeping up with the total balance, and we're repaying the loan. And when we know that, Joey, what were the most profitable loans for Wells Fargo when you worked for them? Shorter term loans or longer term loans?
Oh, shorter term.
But isn't the rate on a 15-year mortgage cheaper than the rate on a 30 mortgage?
It is. How else do you think they're going to entice you to do it?
See that most people forget, though, that they go, well, if they're charging more for the 30, surely they make more on the 30 than the 15. So then why, Joey, do they make more money on a 15 if the rate's cheaper?
Because they get their money back faster. It's a volume game. They're getting more of the principal and more of the cash back faster, so they can deploy it to something else and just keep turning that dollar over and over and over again.
So that second part is really the part, is they get their money back so they can redeploy it. Isn't that the game we're playing? Our objective is to put our capital in these insurance policies and then borrow against it to go put it to work. And so when we're paying it back at market rates, all we're doing is getting the money back in there faster. For what purpose? To go redeploy it, to go put it out. And I was sitting last night with my 10-year-old, and if you guys don't follow me on Facebook, my 10-year-old got $100, won $100 from me this weekend. She held for 2 minutes on this little pull-up bar, because there's this little contest where you can go to a mall or any place and pay $10. If you can hold for 2 minutes, you win $100. Well, we've been wanting to do it. She did it. And so she's been trying to figure out ways to spend her $100, Ernie. And I told her last night, we went out on a little daddy-daughter date, and I said, you know, the thing about that is, remember in the game Cash Flow for Kids, there were assets and there were doodads. I said, what were doodads? And she goes, oh, there were things that took money out of our account. And I go, huh. And what were assets? Those were things that put money in our account. I was like, oh. So those things that you were wanting to buy, what do you think those are? And she goes, you hit her. And it was like, oh, those are doodads. She goes, well, then how can I buy assets? Right? In our life, how many times are we buying doodads, things that take money out of our pocket, versus taking our money and buying assets that put money in our pocket? And I think that's the thing, is that when we get rid of debts, credit card debts and other debts that are that we would consider using our debt priority payoff guide as bad debts, and we refinance them in essence to the insurance company, and we're bringing those dollars back in, where should we redeploy those dollars? Assets or doodads?
Hopefully assets.
Assets. All right. What last questions do we have?
Yeah,
before we jump off.
I have one more, and I think this would be a good question for Joey. A couple of people have asked about how do I structure a policy loan, whether they're using it in this instance in land business or real estate would be another one. How do I know how to structure the loan? Because I think they recognize there, number one, the assumption is, well, I'm the owner, so I need to think about structuring this loan. So Joey, what are best practices when we're going and purchasing assets, how to structure a loan from the life insurance company?
I think it varies pretty widely with this question, because depending on what you're using it for and or what you would have done outside of a policy. Like, let's say, for instance, you're a real estate investor and you're flipping homes. I would not structure a loan repayment of any sort, because you're literally putting capital to work. You're going to literally have maybe 3 to 6 months time frame where that money is deployed into the flip, and then it returns back to you with friends. In that case, I would use the benefits of my life insurance policy non-structured loan repayment option and just not pay it back until I get all the money back, and pay back as much as I can fit back into the policy. You're not going to be able to fit it all, as you've already mentioned. And it's probably one of the biggest, hardest things for people to understand when they read Nelson's book is like, what do I do with all the excess interest? And that's why the infinite part comes in, is that's when we start expanding the system, as you mentioned, into additional policies, because we can't hold all that interest in one policy anymore. The second thing, I guess, guideline around a way to set up a policy loan would be, if I'm doing, like, let's say I'm buying a piece of real estate as a long-term rental, and I'm using a down payment from my policy. Let's say it's a 20% down payment. I'm going to set up that on a monthly payment schedule that the cash flow from my rental property is going to repay as if it were paying a bank. And at that point, I would probably, depending on what the current market rate is, I'd probably pay somewhere like 8, 9, 10%, because to borrow 20% down payment on an investment property would be a very high interest rate. First of all, it doesn't exist. So I would pay back the highest amount, but I would use the cash flow from my policy, from that rental property to repay it. And then there's a multitude of other ways we could structure them. But I guess the rule of thumb in my mind is use it to your benefit, number one. And number two, set up the loan repayment according to the like loan that you're taking. So for instance, if you're, again, in any one of those circumstances, set up the loan to be a mirror of if I had to borrow it from a bank for whatever that purpose is.
Well, and at the end of the day, this is a subject matter where you are in control of this. And that's the beauty, right? Nelson said in the book, the golden rule is those who have the gold make the rules. And when you're putting capital in these insurance policies, you have the gold. You're going to get to make the rules. Do you have to make these payments back as you guys have described? The answer is no. We make those payments back because we want the access to the money. We want to be disciplined. Now, if you're super disciplined and you're shoving all this money back in and your goal is going and buying assets with it, that's okay. But we know that as soon as someone gets a pay raise, JD, what's one of the first things that happens to that extra cash flow?
We consume it.
It gets consumed. Does it have to happen?
No, it doesn't have to.
But does it?
Yes.
Yes, and that's the reason Parkinson's law,
right?
is a law, is because it is repeatable over and over, and we all have experienced that. So if you take over a payment with your life insurance policy, if you don't immediately turn around and start making that payment back to the insurance company, what will happen to the money? It will get consumed. It will be consumed, and all we did then is take our cash and we and we found a new outlet for it, a new fun thing. Now, I want to continue to buy assets and not doodads, and that's the purpose of the infinite banking concept, is one, to manage the banking function, but two, buy assets. And that's what we're getting ready to do. We're about to jump into the inner circle conversation, where members who have participated as inner circle members, they get to hear from other people that are doing this, and we're going to be drawing this out. So if you're not a member of the inner circle, you have a chance, you have an opportunity. It's wealthwithoutwallstreet.com/inner circle, and you can participate and go back and watch these recordings and see all of this played out in real time, and also ask your questions in real time. So thank you for listening to another episode. Ernie, we got another topic we're going to be talking on next week, right?
Is it another roundtable?
It's another roundtable. What are we going to be covering?
Bonus-ode, in a sense. We're talking next week about how can I pay premiums? What are the different options for me to do that?
All right. So if you haven't had an exciting day already with listening to infinite banking and how we pay policy loans, come back next week. We'll totally about how you pay premiums and why you might want to pay a lot more in premiums than you think. All right. We'll leave you at that. Have an amazing day.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand, so that your wealth will never run dry. See you next episode.